UK inflation rose to a 6-month high in October. Welcome to Market Insight. I'm Ramzan Karamali. Well, consumer prices rose by an annual 2.3% in October, pushed up almost entirely by an increase in regulated domestic energy tariffs, after a 1.7% rise in September. Sterling strengthened and investors trimmed their bets on Bank of England rate cuts. But are they right to expect more gradual easing going forward? Well, to help answer that and more, I'm joined by Hetal Mehta, Head of Economic Research at St James's Place. Hetal, thanks so much for joining us. Now, with inflation back above the Bank of England's 2% target, do you expect policymakers to change course when it comes to easing?
I don't think so. I think the Bank of England's been relatively clear that they're going to be going very gradually in terms of rate cuts, and that's consistent with our expectations, given that we have reasonably good economic growth. The latest GDP numbers were a bit soft, but I put that down to noise. But when we think about the stickiness of inflation, and today's numbers obviously highlight that very well, we don't think the Bank of England can be as aggressive as maybe some of the other central banks. So I think actually the inflation numbers were probably a bit too low in the previous month. No one expected them to stay at 1.7%. So that uptick is very much in line with what we'd have expected. But for the Bank of England, I think that the gradual cuts is important. And you have to look at it in the global context as well. Depending on what kind of trade policy we get out of the US, whether the UK is also subject to any kind of tariffs, there has to be a bit of caution around the policy outlook.
You mentioned the Trump presidency there, and if he does go ahead with tariffs, what impact do you think that could have on inflation and on the Bank of England's policy going forward?
So I think tariffs in the US in the near term would be inflationary for US inflation. For the rest of the world, it really depends on the retaliation, whether that's through depreciating the currency or whether that's tit for tat tariffs. So I think it's still quite uncertain. But beyond the short-term effects, the drag on growth that we could get from this would actually be negative for inflation further ahead.
Now, data last week showed that British pay grew at its slowest pace in more than 2 years in the 3 months to the end of September. Surely sticky wage growth is one less thing to worry about for policymakers, though?
I think, again, data is always noisy. In the near term, maybe that's good. But we will also have the effects of higher public sector wage growth as that feeds through into the numbers. The labour market is still strong. We have low unemployment, we have jobs growth. So I don't think wage growth is going to continue to fall very aggressively in a way that we can forget about sticky wages and sticky inflation.
Well, let's stick with wages, but across in the Eurozone. We got data today that showed that wages jumped 5.4% in the third quarter of 2024. What impact do you think this could have on ECB policymakers?
So I think for the ECB, they're very much focused on the growth side, which has been very weak. Don't think that the pickup in wages is likely to have a material impact on their intention to carry on cutting interest rates. And again, they'll obviously have some concerns around what the tariff environment looks like going ahead. But I think for the ECB, the wage numbers are something that will maybe moderate the pace at which they are willing to go or communicate that. But actually, the growth numbers probably still paramount, and I don't think it would stop them from cutting.
Hetal Mehta from St James's Place, many thanks for your thoughts. And that's Market Insight. Don't forget you can watch more videos on Reuters.com.